Hello, everybody. This is Jim Kenny, and this is the Option Professor market update for March the 15th, 2019. As always, I start out by saying that past performance is not necessarily indicative of future results, and doing trading in short-term strategies or options does involve substantial risk of loss, not right for everybody. So do check with your clearing firm, your advisor, and your good common sense before you enter into any type of activity. Just for people who are just coming for the first time, an introduction for myself. I'm Jim Kenny. I'm the content provider at the Option Professor and have been for decades. And a little background on myself. I'm a graduate of Boston College, and I've been conducting seminars for decades to people all around the nation, both live and on the computer, educating them on the uses and the risks of option trading. And of course, there are many uses for options, and we try to go over them on the DVDs that are available at the end of the broadcast. I'll tell you how to get in touch on those. But that's, for income or cash flow producing purposes, also for limited risk speculation, and then finally for hedging, which is something I'll get into in a minute or two, because there's been a couple of examples of hedging that I gave to people recently that have been very much right on. And of course, no strategy works all the time, but knowing how all the strategies work can be helpful when you're trying to look into the inventory of strategies and you look at the circumstances and you try to match them up. That's the key. Art and science. Science is how the strategies work. Art is how you put them together. As always, I do suggest that you tell all your people that you know that are in the market and are interested in learning a little bit more about my views, my opinions, which I'll be giving today, plus a few different strategies to let them know about this podcast. And of course, just direct them to the website, optionprofessor.com. They'll get the link and they'll be in. Also, any questions you might have, you can shoot over to optionprofessor@gmail.com, and I'll try to give you a hand with those if I can. Okay. All right. Let's get right into it here. The stock market right now looks like it's down on the Dow, up on the NASDAQ. So obviously the growth area people are still betting in on. And on the industrial side, they're starting to back off a little bit. We've come up into some resistance zone. Let's do a little quick review. When we went down to 2350 back in December, I was talking to you about people that I had been listening to that were looking for the market to go back towards the 200-day moving average, which was around 2750, and to buy every dip. That was a spot on suggestion. And basically, that was good up to that point. Once we got up to that point, I was looking around for information that might give us a key on where we might be going from there. Then I turned a little bit to the Elliott Wave guys. Now, the Elliott Wave guys work in cycles, right? And they were saying that the S&P, after hitting the 2750 mark, which obviously was a very big move from 2350, had a potential to go to 2820 with an upside potential of the highs of 2940. So that's why I've been suggesting people to be aware that the market could go up to 2820, which it did, and then also to be aware that it could continue up to test that high of 2940. What I've also told them is to keep an eye under the market for the support levels, because if those support levels break, then I think all bets are off to go to 2940. Those support levels right now is S&P, the monthly low, 2680. The VIX, the monthly high, around 18, and the Russell at 1500, and the Dow Jones Transports at 10,000. Let's go around the horn here and look at where those indexes are all right now and see how we're doing. We'll start out with the S&P. And on the S&P, you're at 2816. So you're still up around that 2820. Like I say, this could be very well the high, but you've got to respect the fact that if it busts through here, it's probably going to go after that 2940. Okay. So whatever strategy you're working with, you've got to respect 2940 as a possibility. With regards to, again, where's the support on it? And I am saying that the monthly lows of 2680 would be basically the area. And in this case, right now, you can see if it started to take out that 2700, 2680 area, that obviously would be very negative, and the likelihood of going to 2940 in the short run would probably be taken off the table. Let's look at the other indicators. I look at the transports. Why do you look at the transports? Because again, this is the moving of products and services. And again, a lot of people with the Dow theorists believe that without the transports, the market can't keep going in either direction. I've viewed them as a leader because I'll give you a for instance here. when we were taking off earlier before the drop, we had a rally, as you can see, in June, July, right? The transport's one of the first things to take off. On the move down, starting in October, it was one of the first ones to come down. Now here, we also had a big advance from 8,500 up here. So you saw the low. Do you see where I'm getting 10,000 from? If you take out 10,000, I think the short-term rally is off the table. Something must have changed. So right now, the market's very constructive. The market is a lot of people very positive on it, and of course, that's not always a positive. So the bottom line is that the consensus. I'll show you where the VIX is, very low, and you got a market that has not been taken out that high recently. You see the transports are underneath the recent highs. That's not a positive thing. And if it takes out 10,000, again, you'd have to get the umbrella out because it's probably going to start raining. With regards to the other indicator that I look at that has been very friendly to me is the Russell. Okay. And again, I have found that the transports and the Russell have been leading us up and down. So I am very much in keen watching at the Russell as well. Okay, so here are the Russell. Same thing as the transports. You notice they're kind of identical charts, and so that's why I keep an eye on them because I think they tell the story, and they tell the story before the S&P gets it, in my view. Now you see it was rallying up there, and then when it rolled over well before the S&P, I believe, and then the big turn up. That's a big rally, 1250 to 1600, and can you see that's the triple top area there? Now, if you take out 1600, that'd be like taking out 2820. That's like taking out 10,500 on the transports. So the bottom line here is you're in a quandary at 1550. If you take out 1500, like I say, I think you can kiss the short-term rally goodbye. And if you take out 1600, you're probably going to take a run at the all-time high of 1742. So that's where you are, and you want to be careful that it doesn't turn on you. But right now, you cannot be too negative on it because overall, we've just had a little bit of a dip after a big run up. Okay. Now, what else am I looking at? I told you I look at the VIX. The VIX. All right. Now, on the VIX, it is at today 1296. So it's collapsing. Okay. And as I told you on the VIX, if you are 25 or above, you're in a position where the market could go into the abyss because you'll notice most of the big panic drops happen after we break 25. If you are between 17 and 25, the market is generally going to be pretty constructive. If you get under 15, like you are now, the market is either very close to making a turn, like it did back here in October. So if this thing now starts popping above 18, you're going to be seeing a big drop in the stock market. So watch the VIX. If it gets above 18, you're going to see a big drop in the stock market, in my view. You can see right now, once it's down here and then it pops above 15, that's the beginning of a big drop, right? Okay. Now, it can also stay under 15 for a while, and there you're going to rally, right? So if we can remain under 15, then you got to be constructive on the stock market, I believe. Okay. And so bottom line, keep an eye on the VIX. It's definitely near the lowest level. It hit 1253 today. It's already at 13. So if this market starts to reverse and you get back above 15, then that would be a caution flag to me that maybe the market has hit a short-term peak and cannot get through 2820. Okay. So again, those are some of the indicators that I'm looking at, and I like the numbers to dictate what I do as opposed to have a crystal ball because, crystal balls, you end up eating the ground glass when they break. So the bottom line is it's helpful to have lines in the sand that are built on price. The other thing I believe in is the moving averages. Now, I'm going to give you an idea on hedging that I talked about. In fact, I wrote a little report on it, and basically it was on hedging. And this was the stock I used as an example. I wrote this about 2 weeks ago. We were at that time in the 440 area on Boeing. Okay, this is a good example of what hedging is all about and why and when to hedge. Okay, and I issued this short note to on the hedging, like I say, about a week or two ago. Let's find out when we peaked out here real quick. Okay, hold on. You peaked out here at 446, but let's see if I can. Let's see if I can give you the date. Okay, the date was March 1st. Okay, like I said, a couple of weeks ago, I wrote a thing when we were at about 440. Okay, there's your thing. Now, do you see the index? The 200-day average was 355. Let me help you with some math here. This is a behemoth company, $210 billion market cap. Now, we were at 446. Okay, at the time I did it, it was 440. And you were at 356. You see where the cursor is right there? 356 on the 200-day average. So you divide that into the 446, and what do you get? You get about 20% above the 200-day moving average. In a big company like this, if you get 20 or 30% above the moving average, you are overbought. I'll give you an example. When another example, Amazon. Amazon was at 2055 or 2050. Let's just call it 2025. And the moving average was at 1550. If you divide that into 2025, you'll get a percentage. You take your 2025 minus your 1550, and you get 475. You take your 475 and you divide it into 2025, and there you're 23% above the moving average. When huge companies get 20% or better above the moving average or below the moving average, that's the time to start thinking the other way, because the trees don't grow to the sky and the abyss doesn't exist, right? So the bottom line is that that's the time to start thinking about hedging. So here's what I wrote in the report. I said, as a hypothetical example, if you had Boeing at 440 at the time, you could sell a 470 call. That means you're going to give the people the right to buy your stock from you, meaning you're obligated to deliver stock at 470. Now, again, the stock had already gone through the roof, right? So not only did you say, I'm not selling at 440, but you said, I will be willing to sell at 470. Now, after this kind of a rally with these gaps underneath, don't you think that is not exactly a bad bet? With it 20% above the 200-day moving average, having that kind of a run. Okay. Now, you sell the 470 call and you're going to receive a premium. That means you're going to take the call buyer's money and you're going to collect it. What are you going to do with that money? What you're going to do with that money is you're going to buy insurance at 430. So now you've bracketed Boeing and you had this kind of a run up from 280, 300 all the way up to 440, and you could still make up to 470. So that's your ceiling for the time that the contracts are in force, 470. And then you take the 430 put with the premium you paid. So you didn't even, you didn't have to come out of new cash for it. You took the cash flow off one and you bought the other with the cash flow. Okay. So what if the market went up above 470? Obviously, you'd either get called away at the 470, or you could buy back the 470 call, or you could buy back the 470 call and roll it up to a higher call. How about if it goes down to 360 like it's doing? Well, rather than saying, let's say you had 1,000 shares for say, right? Well, if you had it at 440 and it goes down to 365, or let's call it 370, just to make the math easy, that's going to be $70 on 1,000 shares. You're out 70 grand in equity. Of course, you're still on the stock, right? But your equity, if you had, if you had 400 grand in it, you got 330 grand. Some people don't like to have their statement look like that. What if you had done the collar? Well, if you had done the collar, your equity would have been protected at 430 because you had the right to sell at 430. And right now you could cover that put if you wanted to, collect that money that you collected, and then basically you're long down here again. Okay. But the point being is that the collar would have protected your equity from the rollover. And all companies will roll over at some point. That is just the laws of gravity. So knowing this strategy is very important. If you have different stocks that you're interested in looking at how this strategy might work, go investigate the puts and calls. And if you have any questions on the mechanics of it or whatever, I'm more than happy to give you a hand. Again, OptionProfessor@gmail.com. And then shoot me your question, and I'll try to give you the best answer I can. If I don't have the answer, I'll let you know. And of course, ultimately, you can put it into your decision making one way or the other. and then you can make your own decision at the end of the day. The more information you have, sometimes the better you are. So again, that's why we like to look at the hedging. That's why we like to protect our equity from negative down moves. And again, is 2820 going to be the temporary top? We don't know that. Is it going to make a run for that all-time high on the S&P? We don't know that either. But the point is, from time to time, you may want to lock in a little bit of short-term gain, or not lock in as much as put parameters around your equity, because now again we're getting a little bit of a rally in the S&P. So again, if we don't take out those support zones and we get some more good news, again, we could make a run at the all-time highs, which is basically what I've been saying. At that point, I think you'd have to recalibrate because, again, the interest rates are dropping. Let me tell you, I'm going to show you why these markets continue to rise, even though the news is not that fabulous. Okay, one, of course, is that has the Fed has changed their stance in January as far as their tightening, and of course that let the dogs out as far as people that were worried about a hiking of rates. But you can see here, because we got some weak economic data today, that the yield on the 10-year note is been dropping dramatically. When that happens, valuations can expand easier because there's not much competition from the fixed income area. So again, that's why you're seeing valuations expand, because the interest rates look like they're down, and according to popular opinion, the Fed is on hold for as far as the eye can see. If that's not a miscalculation, then they may be very accurate that these multiple expansions can be there. Also, there is some hope that the earnings will maybe be better than people think. So again, the valuations again can expand more when the rates are down. And that's basically what's been going on. The problem is when Q1 earnings come out starting next month, and if the inflation numbers, which have been very low, although I find it hard to believe they're that low, because as I go around living my life, I see prices rising, not dropping, on most items that I buy. And if oil gets above $60 a barrel in the second half of the year and the dollar starts dropping, that could change the entire picture. So the first half of the year is one side of the movie. The second half of this year may look totally different. We'll have to see. Also, China and the U.S. and their trade stuff seems to be going back and forth. It could very well turn out that Kim and Xi, the two leaders in the Asian area, may be looking at Trump with an eye that that his tenure may not be permanent, and maybe waiting him out might be a better way to go than signing away the farm to somebody who may not be there in 18 months. So, of course, that could be a factor in these negotiations as well. At any rate, right now, people are buying into stock thinking that blue skies are ahead, and the VIX down at 12 is telling you it's everybody on board. Okay. Second thing is, this interest rate market is way down, and everyone is telling you there is no inflation and the Fed will not hike. That's what everyone is saying. The question is how long will everyone be right? And only time will tell. But again, you need parameters. And as I told you before on the 10-year here, you got to get above 280 before you can even think about it closing that gap at 3%. And if it gets above 280, then you start worrying about higher interest rates. Right now, there is no evidence that interest rates or yields are rising. And that's why people are jumping into high yield as if it's money market again. And let's take a look at HYG, because again, if yields will remain low, and the stock market is going to remain strong, then this kind of stuff that pays 5.34, which is high yield corporate bonds, are attractive to people because they feel the default risk is not that great, and they also feel that the Fed is not going to be a problem. If the default rate is not going to be a problem and the Fed is not going to be a problem, then people do like to get the yield advantage, because you can get, I think, 4% more on a similar maturity between a high yield bond and a treasury. And of course, that's pretty fat if the risk of it dropping like it did when things were getting tough. See, if you want to know what the risk looks like, if you get a December sell off like we did, that's what happens to corporate bonds. High yield, bam. Okay. And that's a pretty good size drop for a fixed income product. Now, of course, Fed goes on hold, market snaps back, bam. There goes your high yield. But again, getting 5.34 yield, like this says, versus a 2.5 yield in a treasury, obviously is favorable to the high yield from the standpoint of cash flow. All right, so that gives you a little bit of a rundown on the fixed income area, and it also, and of course, other things that people like to look at are the leverage loans. This is a short-term floating situation for Fidelity that again pays 465. The duration is quite short, and 950 is the price. But as you can see, if the market turns down, these become quite a bit more risky from the standpoint of the principal dropping from $9.70 area down to 9.20. But again, if the Fed's out of the picture and the default risk is perceived to be low, then obviously people find it interesting because 4.65% with the duration that they've got looks very, very interesting. Okay, nothing goes without risk, though. That's why I'm showing you when they change the tides, people find out they're swimming naked. Bam, you go down there like that. Okay. All right. What else do I have for you today? Let's see at some of the sectors and how they're doing. The ones that people keep touting are energy. So let's look at XLE. And there you go. To me, it looks like it's in a quandary because if this oil can't get above 60, you're not going to get much of a run out of this thing. And so basically, you need to get above 60, and then this thing could maybe clear 70, and then you might be up for a longer term uptrend. Okay, so right now it's in a basic holding pattern, but people think in an asset allocation, having some energy is not a bad idea. The other thing they love is the financials. And let's take a look at what the financials look like. They have been having a hard time getting out of their own way. And that would be all your banks, your JP Morgans, your Wells Fargo's, your Bank of America's, and all the rest. And basically, on that sector, again, having a hard time getting out of its own way. It needs to get above 27, 28 to really get going anywhere. And so basically, that's what the financials look like as well. It looks very similar to the market. If you take out 27, you're probably on your way someplace. If you take out 25 and a half, then the party might be over short term. Okay, industrials. That was another one that people liked. Let's look at the Vanguard sector there, the ETF. And on the industrials, people were pounding the table on that pretty good. Let's see what it looks like as far as that's concerned. Okay, again, very similar to the market. This thing starts rolling over and taking out 135. I think you can stick a fork in the short-term rally. But if we get above 145, there you go. So let the numbers dictate more of what you're thinking as opposed to trying to do too much predicting. Again, the industrials are also probably being hurt maybe by some of the things that are going on with Boeing. Let's take a look at another sector that people seem to have a little eye on now, which is materials. And on the materials sector, this is, the cost of the materials might be rising a bit. And so there you go on that. Again, they all seem to be saying the same thing as the S&P is saying, and like the Russell and the transports. I mean, are we going to be able to, we've made a big run, you pulled back, we rallied up. Are we going to be able to take out that resistance zone? And if we do, then again, you put your party hats on and you're probably going to make a run at the all-time highs. But if you start taking out 120, maybe doing some hedging tactics would not be the worst thing in the world, because what goes up, like that may be able to roll over, especially if some of the wheels start falling off the bus. Again, with the VIX down at 1296, we're either in a bull phase that's going to go right through to the highs, or this is going to be an overbought condition, because when you're overbought, the VIX can go down to 1296. Obviously, that's a bullish reading. And so the bottom line is the enthusiasm and the participation may be pretty complete here. And without new news, and if any bad news hits, again, people would want to sell. And just like when you're down here, don't forget, this is a merchandising operation. You need to have a buyer and a seller. When the market's tanking like this, there are no buyers to speak of. So the guys who perform a market, they drop the bid as far as they can, and they take in all your selling down here, knowing fully well that there's not unlimited selling, right? So they feel like down here, they can take all your selling in. That's why the volume is so high. See the volume? There's the volume. And this is on this one thing. I can show you many things, but see, this is huge volume. And somebody is buying down here. The market maker guys, the guys on the other side of your trades, they're down here buying. Now we've had a huge rally up here, but the volume is nowhere near what it was on the down, right? So if this thing is done up here and people start selling because they want to take these gains out, they're going to drop the bid if that happens. So don't be surprised, because there has to be a buyer for every seller. If everyone is buying now, who's selling? And you've always got to worry about that, because there's two guys in every trade, and one of them's probably an idiot, and hopefully it's not you. So the bottom line is, again, be careful now, because if it does roll over for a reason, again, it could be a situation where it could hit a vacuum. Right now, though, there's no evidence of that. I just want to show you how and why things can really get out of hand when the volume. See, this is everyone holding, 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 and then they decide to sell. Well, if they all want to do it at the same day, that means there's nobody on the other side of the trade. And again, when the Fed said we're going to pause, who's selling stock? Nobody. So what do you think the guy on the sell side does? He raises his offer as high as he can, and everybody who wants in has to pay through the nose, which is what they've just done. Now the question is there news behind it to keep the thing going? Right now, obviously, there's no news behind it, and that's the problem. But if the news is coming and you blow it out, then the all-time highs are in play. Okay, that's how I see it. All right. Any other things going on here as far as the sectors? Utilities. That's where people hide when they think that they want to be careful. And they want defensive, right? Defensive. Well, look at that. All just about all-time highs, right? 130.72. You're at 130.18. So people are hiding out in utilities, because when interest rates do go down, the utilities become more attractive, because you see their yields are pretty good, 313 here on the Vanguard Utility ETF. And there's obviously individual utilities that pay even higher. So obviously there has been a bit of a stampede into this. And again, that's not been a bad place to hide. Another place they sometimes uh, look to for cash flow are REITs. One of the REITs I watch is Annaly. And Annaly has been fairly stable and paying pretty good. So again, it's a 3 billion, I think, market cap, and it's 1162 yield according to the screen here. And as you can see, since it went down to 975, it's been pretty much trading between 975 and 1025. So that's your principal, fairly stable during this period. And then also that yield obviously is very, very strong. But again, it also can bounce the other way. So it's nothing is a one-way street. Consumer discretionary. People out there, are they spending money? That's all the retail stores here. Consumer discretionary. Let's take a look at what the Vanguard ETF looks like there real quick. All right. There we go. And the ETF looks pretty good here. It is, again, pretty much in that stall zone. You start taking out 170 on the discretionary, again, you got a good chance of running towards the highs, right? And again, where's your down? You break under 165, 163, and that would be on the defensive as well. So we are getting to the push comes to shove zone, I think. And it's either going to make a run at that 29.40, or, like I say, it's going to give up because maybe the China deal doesn't look like it's going to happen. These guys are going to wait out Trump. Obviously, the guy Kim's already going back to the nuclear stuff again. So there's stuff like that going on, and that could take the bloom off the rose a little bit. Right now, there's no evidence of that. So you have to respect 29.40 as a run possibility, particularly with the VIX down at 12.96. But from a sentiment standpoint, we're overbought. From a situational situation, we are extended on valuation in a little bit. And we do have news coming up that's going to be our make or break, and I think that's Q1 earnings, and that's going to start happening in the not too distant future. Okay, last thing is on the gold and the dollar. Again, the dollar is in a situation here where it has resistance at 98. And it is on the defensive a little bit today. If we can see, it tried to break down, but it didn't do it, right? So now, if it can be 594 area, you can see that there's plenty of real estate underneath, right? So if this dollar does start breaking down in the second half of the year, then I think the other thing that would happen in the second half of the year And why would the dollar drop? Because our deficit's going through the roof. We're late cycle and we're running $1.3 trillion deficits possibly. I mean, that's huge, right? And that also could have an effect on the debt market. So that's why things could look a lot different in the second half of the year potentially. One thing that I've been talking to you about, and I said it would be time to take a little bit off the table last time I spoke to you, is in the gold. Again, gold looked very good there for a while because, again, there was some inflationary pressure in wages that people were concerned about. And right now, like I say, it is in the stall zone. But I started talking to you back this in the fourth quarter, and look there, up, back, buy, and now it looks a little bit weaker. Okay, because you took out these lows at 22. All right, that's because the dollar firmed up. That's because the inflationary numbers on CPI have not confirmed what I've been talking about. Okay, but if you do get a weak dollar, I think you'll blow out 24 later in the year. If you don't, and the dollar gets very strong, then this move might be over, at least for the time being. All right, that's this week's show. I am going to be back with you next Friday. This is Jim Kinney. You got a question? Shoot me an email. OptionProfessor@gmail.com. You got friends or associates that are involved in the markets? Tell them to go to OptionProfessor.com, get that link, and tune in every Friday. I'll give you an update. I'll tell you what I think. And until then, good luck and good trading. Great weekend, everybody. Be back with you next Friday.